Welcome to another video. In this video I'll just be continuing from where I ended in the first video where I was introducing financial markets. So in the last video we described what financial markets are, types of financial markets, important apps and websites, fundamental analysis, we talked about technical analysis, we talked about sentimental analysis. And we said that in part 2 we will continue with risk management, trading plan, entry and exit strategy, and finally trading psychology. So if you haven't seen the first video, I recommend that you see the first video so that you connect the dots with this current video. Let's get straight into business. So we covered this in the first video where we described quite a number of things, and sentimental analysis is the last thing we talked about. So with this video I'm going to begin with risk management. On one hand, traders want to keep any potential losses as small as possible, but on the other hand, traders also want to squeeze as much potential profits as they can out of each trade. This statement simply means when you execute your trades, make sure your risk is as minimal as possible and make sure your profits is as much as possible. You have to have low risk and high reward kind of setups. So risk management can boil down to what we call risk reward ratio. So risk reward ratio is simply how much you're willing to lose versus how much you're looking forward to win. So the most ideal risk reward ratio is 1 to 3, meaning you're risking, for example, $1 to make $3. So this is a minimal, this is the most ideal risk reward ratio because the market will usually move in a 1 to 3 kind of setup. It's easy to catch such moves and it actually helps a lot. Then here are 10 tips for Forex risk management. So here are our top 10 risk management tips which will help you reduce your risk regardless of whether you are a new trader or a professional trader. Number 1, educate yourself about Forex risk and trading. Make sure you have enough information of what you're doing, and then use a stop loss. A stop loss is simply an order that you put implying that when the market reaches there, it should stop you out and should cut out all the losses that you are currently in. Then we have a take profit. So a take profit will secure profits for you. When the price reaches at the TP, which is take profit, it closes with you being in profits. And then the fourth tip is that you do not risk more than you can afford to lose. Make sure as you enter your positions, risk only what you are comfortable losing, something that you can let go and let the market do whatever it has to do. Then you have to limit your leverage. Don't use excess leverage because just as good as it sounds, it's also bad. You can easily blow an account with unlimited leverage. Then you have to have realistic profit expectations. You shouldn't have unrealistic expectations because it just puts you in a state that is not ideal for your trading. You need to have a very good expectations of what you should be seeing in the markets. Don't daydream about things that are unrealistic. It won't help you on your journey. Then you have to have a trading plan, and then you have to prepare for the worst. Don't always expect good from the market. You will encounter losses many times, but what's important is to make sure your risk is low and your reward is high. Then you have to control your emotions. You have to learn how to manage how you react to losses, how do you react to wins. You have to pay attention when you become overconfident. You have to know when you're scared. so that you can overcome those limitations, because mostly when we make errors, it's due to our lack of emotional management. Our low emotional intelligence is what may cause us to fail in the market most of the time. And then lastly, you have to diversify your forex portfolio. So right at the bottom here is a link to where I got these tips from. I'm going to put it in the description, and you can easily access more details about these tips when it comes to risk management. So the next thing that we're going to talk about is a trading plan. A trading plan, just as it sounds, is a roadmap for how to trade. This means no trades should be placed without a well-researched plan. The plan is written and must be followed and unaltered unless it is found not to work or the trader finds a way to improve it. A basic trading plan includes entry and exit rules, as well as risk management and position sizing rules. So on your trading plan, mainly you'll be talking about how you're going to enter a trade, what you'll be looking for when you enter a trade, how you'll be taking your profits, and how you're going to exit the trade. What conditions will give you a sign to leave the trade? What conditions will give you a sign to enter or to take profits or to cut the losses? So that's what a trading plan is all about. There are so many trading plans, and each trading plan is unique to the trader. Each one of us is unique. What may work for me may not always work for you, but in future videos I'm going to explain about the trading plan and just give you my own trading plan so that you can customize it and use mine as a template. So the next thing that we're going to talk about is entry and exit strategy. So entry and exit strategy is a subtopic of trading plan, just like I mentioned in the previous slide. You have to have a specific criteria that has to be met before entering a trade, and in the same way, you need certain indications. You just don't enter the market anyhow. So you need certain indications that will tell you when you need to exit an open position, or either take profit or stop loss levels. And then some people use trailing stops, which simply means adjusting your stop loss when the market is moving in your favor, while maintaining the same stop when your market is moving against you. So let's say you are in an uptrend and you enter with some buy positions. A trailing stop means when the market moves up, you move your stop loss closer to the price. But when it starts moving against you, you maintain wherever the stop loss is. That's what a trailing stop looks like. So that when the market shifts and starts going to the bottom side, you have already secured your profit. So this is just an example of how I trade. I don't let the market go back to my entry without taking some positions off if I'm in profits. That's for me, that I consider that to be greedy. At least take one position so that you remain with the other in case you want to hold. But personally, I do not even hold positions for a long time. Patience is not easily cultivated when it comes to trading, but once you achieve it, it's good. So that's about exit and entry strategies. Then finally, this is a very important topic and a very key aspect of trading, which is trading psychology. Trading psychology refers to the study and understanding of psychological and emotional aspects that influence traders' decision, behavior, and performance in the financial markets. So it has to do with your emotions, it has to do with the way you perceive the market and all those things. So it involves examining the impact of emotions, cognitive bias, self-control, discipline, and mental states on trading outcomes. It recognizes the trader. It recognizes that traders are not purely rational beings, but they are influenced by a range of psychological factors that can lead to biased thinking, impulsive action, and suboptimal decision making, things that are not even making sense. Trading psychology is responsible for those irrational mistakes that we make and those unnecessary errors. So it is of great significance because a majority of trading errors are as a result of trading psychology. So you should master it. And that marks the end of the introduction to financial markets. I'm going to leave links to important websites as well as my WhatsApp group and all those things in the description. Make sure you follow my Instagram page to get content like this. For now, I'm out.